Assalamualaikum. Hi, this is our presentation for investment management, FIN 358. The chosen theme is the investor's journey from concept to instruments. I am Hawa binti Ebu Zulkifli.
My name is Nura Aina Anisha binti Syarifudin.
My name is Nur Amalina Hurin binti Muhammad Helmi.
My name is Nur Aimaisara binti Abdurrahman.
My name is Shafia binti Samel.
And hi everyone, I will explain about the investor journey from concept to instrument. First, we explain about the investment concept. Investment when we put the money into an asset with the hope of getting the profit in the future. The purpose of the investing is to grow our wealth, protect our money, and achieve our financial goals. The example of investment, we have the bond, stock, and real estate. Next, we look at the investment goals. There are two main categories of investment goals. For the personal goals is we invest to get the protection insurance and to provide a home of our family and to prepare fund of our children education. For the financial objective, which is focused on the keeping our principal safe and protecting our money from inflation. Lastly, we have the risk return trade-off. We have two types of risk, which is the systematic risk and unsystematic risk. For the systematic risk is affect the whole of the market and cannot be reduced by diversification. But for the unsystematic risk, which affect only the specific company or industry, and this can be reduced by diversification.
I'll talk about the primary market. The primary market is a market where new securities are issued and sold to the investor for their very first time. This is the place where the companies raise fresh capitals to support their business growth. In the primary market, the investor buys securities directly from the issuer, which can be either company or government. There are four main channels in this primary market. First is IPO, or initial public offering. This happens when a company sells the share to public for their very first time with the help of investment banker. Second, private placement, where the new securities are sold to the selected group of investor only, usually institutional investor. Third, which is a right offering, which give existing shareholders to the right buy additional share, usually at discounted price. And the last one is ESOS, where companies issue their new shares to employees as a rewards program.
Explain about the secondary market. The definition of secondary market is where existing securities are bought and sold among investors. There is no new capital raised. Ownership transfer in secondary market happen from one investor to another. Buyers purchase from other investors in the market. First one is the main market of Bursa Malaysia. It has the standards of quality, size, and operational excellence. The second one is ACE market, sponsors-driven market for high-growth companies. Here is the example of the investment from the Bursa Malaysia website.
First, the definition. Real assets are tangible items, meaning you can physically touch them. Assets are different from financial assets because they are not as liquid. This means it can take longer to turn them into cash. There are also disadvantages. First, real assets require high capital, so you need a significant amount of money to get started. They also require a long-term commitment, meaning you usually cannot buy and sell them quickly. Another drawback is low liquidity, which means it can take time to convert them back into cash. Lastly, there is tenant risk. Now, for the advantages of real assets, one major advantage is easy financing. Banks and lenders are usually willing to provide loans for things like property. Real assets generally increase in value over time. There is also high demand, especially for assets like real estate. Finally, real assets offer stable long-term returns, making them a reliable option for long-term investment.
I represent about financial asset. Financial assets are instruments used by organizations to raise funds, and they are very liquid, meaning they can be easily bought and sold. Financial assets are divided by several types. The first one is common stock. This represents ownership in a company. It has higher risk but also higher potential return. The second type is bond. Bonds are fixed income securities where the issuer pay a fixed interest based on contract. Preferred stock, which is a hybrid between bond and common stock. It is provide fixed dividend and holders have higher priority than common stockholder. Then we have unit trust. These are investment pooled from many investors and managed by professional fund manager. For derivative instruments such as options and warrants, their value depends on the value of an underlying asset. Lastly, we have saving and insurance, which are more focused on financial security and protection. Overall, financial assets provide different levels of risk and return, and each type serves a different purpose for investors.